Hello, everyone, and welcome to this afternoon's webinar. Well, it's afternoon for us here in the UK. It's absolutely pouring with rain, almost pitch black, and the only good thing is it's shortly to be the shortest day of the year, and then hallelujah, we'll have lots of daylight in the afternoon. But wherever you are in the world, you are very welcome to join us for this session. Now, if you've read the emails that have come out, the usual one that we send out with these webinars, you'll know that we've decided to change the format very slightly again. I'll explain that as we go through the webinar, and also tell you a little bit about what we plan to do for next year. But before we start, can I just draw your attention to the disclaimer, which I know you can see on your screens because I can see it on David's screen as he's over on the other side of the room. We all know trading can be an extremely risky endeavor. Please don't ever use money that you cannot afford to lose. Brilliant. I'll just take that out of the way very quickly. And I've got some charts up here, which we will come back to in a second. I can see we've got some people perhaps who've not been with us before. And essentially, we've done all sorts of things in these in this afternoon session. In fact, we've even held the session in the evening when we sort of first started. But what we've decided from feedback and just sort of on the kind of on feedback, is this particular session we are only going to be looking at the indices. We may look at one or two commodities, but it's purely indices. We had actually tried to do indices and stocks, but it really didn't work because traders who trade the indices are one breed, and traders who like to trade stocks are another breed. Now, both are perfectly able to use the volume price analysis methodology, because those of you who have the book and have read the book will know it is applicable to any market, any instrument, and in any time frame. And time is something we are actually going to be looking at a little bit more closely in this session, and how these hugely significant VPA signals that come along at the start of big moves, potentially big reversal moves, i.e. accumulation and distribution, what the time that it can take for the signals to actually develop, as it were. And it's particularly appropriate on the indices, and we're going to refer back to, in fact, some posts that David and I did going right back to February this year and April, and we'll explain that by looking at the chart. So that's time in a very long time frame. We're looking at the monthly charts, and also the time that you have to give to the VPA signals to actually come to fruition, as it were. Then we're going to move over to David and look at the NinjaTrader, and we're going to look at exactly the same principles, but actually on a day trading basis, where you'll see accumulation, distribution, excuse me. Apologies, we've just had someone unexpected come to the door, so if you could just bear with me literally for a couple of minutes, and we'll be straight back. Apologies about that. It was someone turning up saying that we had for a collection, but nothing to do with us. Right, sorry, time. And how VPA signals, you have to allow them time and breadth to develop. And what I was going to say, we're going to look at that in more detail, particularly accumulation and distribution, two of the most important concepts in VPA. And I just wanted to highlight as well that obviously the methodology is in the complete guide to volume price analysis, but it does have a companion book, which is, as you can see, investing and trading using volume price analysis, and they're actually worked examples. And in that book, there are, again, all the time frames are covered. Just going to pass over to David for a second, because he doesn't always get a chance to say, to join in early doors. He's just coming back.
I will. Sorry, a bit chaotic here to start with. Apologies. All sorts of things going on. So many apologies. And great to have you along today. If this is your first time, then we run as a two-hander. Anna's on one system, I'm on another. And actually what we're doing today is we're flip-flopping between the two platforms, MT5 and NinjaTrader. And to be honest, on NinjaTrader is very much about futures, but getting into the futures market, it can be, you do need a specialist broker, and it can be expensive. It's a more expensive way to trade the pure markets, if you like. And a great way to dip a toe in the water is to start with the MT5 platform. If you're not familiar with it, it is a multi-asset platform, and it opens up these markets. Whereas the MT4 platform, which I'm sure you are familiar with, is very much Forex-centric. MT5 is multi-asset, so you have all the indices, you have commodities, you even have stocks on there. So it really is a great way to get into this market, and it's an inexpensive way of getting into the market as well, because you have all the markets there. And indeed, not just for the US markets, you'll find indices for many platforms now offer Australia, offer Far Eastern markets, Far Eastern indices, for example, and lots of commodities too. If you have any questions, please just drop them in the chat box. Happy to answer them there if they're short ones. If they're longer, then we will answer them on air for you. So I'm happy to answer those there and then. So I'm just going to pass back to Anna and we will get going.
Rather than me just go on about the actual post that we did at the start of the year, you can pick up the thread of what we wrote on my blog, and it's under the market analysis tab at the top of the site. And basically, way back in February the 3rd, as you can see here, and this was the title of the post, the first significant pause in the YM, and you can see here that there's massive rise in the YM, as similarly on the ES and the Nasdaq. And it was really, as I said, it was the first inkling, and this is what I was trying to say, is you will see this in all the time frames, and the danger is that you'll think, oh, that's it, it's the signal, now it's the time to get in. But actually, the post that I would really like you to, if you have time to go and have a look, is the one that was written in April, and it's here, and it's actually called "Is the Big Short Here at Last?" There was a lot of volatility. You will recognize that the combination of candles that had developed since that first pause point, and in particular this candle here, which looked to be a hanging man candle with a lot of volume and volatility. And the one thing you can say at potential major market turning points in all time frames is that you are going to get volume and volatility. And the volatility and the volume coming in, what it also does, it's designed particularly to trigger the feeling of the fear of missing out, the FOMO. And you can see this all the time. We saw it in this time last year in cryptos, if you remember that go back just before Christmas. You know, people were saying after, you know, December last year, that December this year, it was going to be 100,000. David, cryptos, 100,000? Yeah, Bitcoin was going to 100,000. And it's this fear of missing out. And it's always done with volatility. But to go back to what I was saying about the time that it can take for the signal to develop, if you like, and let's bring it up here. That was the YM. So I'm actually got the MT5 platform rather than Ninja, because David's got Ninja, and I'm actually going to put the monthly chart up. Here we are. So this was the candle. This was the hanging man candle with the volatility. But you can see here how long it actually took. You know, we saw the initial. It was a shooting star on one of the faster time frames. Oh, great, with a ton of volume underneath it. Then this was really a dramatic candle on the YM. But look what happened. It actually, it went on back to retest the high of January. But look at these three candles. These are the most significant three candles. These three candles going higher, narrowing spreads and falling volume. Then we had this candle here with a ton of volume underneath it. What's that telling you? Then possibly now it is time that we are going to see a move lower. And this candle here, this was last month's candle. This was November. This is the monthly chart. What do we get? It's not really a doji, but you see a ton of volume underneath it, and the price isn't going anywhere. And this is the candle that is developing at the moment. So from this initial signal, notice the time that it has taken for the price action to, if you like, to mirror what we saw at the beginning of the year. But this is the monthly chart. You would expect that. You're not going to get a sudden, reversal in days or weeks. And this sideways price action, this range that we're in at the moment, it could actually even continue. And depending on what happens tomorrow with the Fed and whether the Fed are actually going to be, to what extent are they going to be influenced by what's been happening in the bond market and the equity markets, and how dovish are they going to be? And there's a press conference as well with Powell. Who knows? So it could be setting up that this is actually, if it breaks through, and have a look at some levels here and what we've developed to help us with levels. You can use Fibonacci, significant levels. We've actually, let's have a look, put the data navigator on, developed the Camarilla. Let's just put that on here there. This is on the monthly chart. So there we are. And what's really significant is that the YM has stopped at the S level, the S6. We've, on the indicator that we've developed for the Camarilla, our version of the Camarilla indicator that we've developed, is we have 6 levels, not just 4. Under the usual protocol, it's once it goes beyond the 4th level, either S4 or R4, it breaks through, then it's taken as a potentially a valid breakout. We've actually put one extra in, and it's the S6, and the S6 is really like, the last line in the sand, as it were. And we can see here it's actually bounced off. It's on my platform, it's 23,458. It's not going to be exactly the same value that you will have in the futures market, because this is like a synthetic contract. It's taking the data from the futures market and it's actually putting it out as a CFD, but it's pretty close. So the S6 there, so it's telling us this is really, really important. Now, if it goes through the S6, well, we'll have to look at a Davis chart and see what the accumulation and distribution indicator is saying over there. Where is it likely going to stop? A lot of it is going to depend on what the Fed says tomorrow. So go back to the daily chart. Now, what also you have to accept is when you have these congestion periods, these long periods, where you're having distribution and accumulation, and you see this in stocks, Forex, all markets, is Does that mean it's always going to be bearish? Well, no, there are always going to be buying opportunities. And this is where it comes down to whether you're an investor or a trader. So as a trader, you will look at that. You will know that it's in a congestion. You will know that potentially it is in a distribution or an accumulation. But is that going to prevent you from maybe buying? No, of course not. Because if the signals are there and the opportunity is there to take a trade, and we'll look at that at some of the potential trade setups that David has been looking at, then you will go with the flow. You will go where the money is flowing, and if it's flowing in, you will buy, and if it's flowing out, you will sell. So that's anything you want to add to that, darling, or is that it? And otherwise I'll move over to you. If you've got any questions on anything that I've got here, then please do just put them into the chat box. And just to finish off, I've got the what am I doing? That was actually the S&P. Sorry, what am I saying? Here it is. Right, here we are. This is the YM. Then we have the S&P, and I've actually got the Nasdaq up here as well. Look at the monthly. Now the Nasdaq, it hasn't had quite as long a congestion phase as the other two indices. It's pretty much, it's always been leading, David, hasn't it? Yeah, on the Nasdaq as well. So anyway, so that's that. And just to end on the accumulation and distribution, just to go back to my site for a second, just to look at accumulation, potential accumulation, although we're not quite there yet, is my latest post on GE. Let's have a look. Stock market, under stock market analysis. There we are. Here we are. How low can GE go? That was done. That was today, earlier on today. And again, that's been in, as you know, it's been an absolute free fall. And you know, you can read on there what we would be looking at. Hopefully, when the accumulation phase may start at some point. So can I pass over to you now, David? Yeah, sure. Is that okay?
Just switching screens. Hopefully that should be coming up, should be on your screen now. Just to move my chat box out of the way. Different screen layout to Anna's. What I've got here, this is the YM. So this is we're into the March contract already, amazing, for 2019. And I've got time-based charts, and I've also got non-time-based charts. I've got the Renko in the middle here, which is obviously non-time-based, but I've primarily on this workspace, I've got the time-based version, and I've also got the tick chart set up for an equivalent workspace. So I'll flip over to that in a moment. But basically what we're looking at here, we've got the 5-minute here, we've got the 10-minute, we've got the 15-minute up here, the 30-minute, the Renko in the middle, and down here at the bottom right, we've got the 60-minute for the particular index. And applying multiple time frames is just so important the whole time. Excuse the pun, but it is. And it just gives you a heads up of what is going on. The market is... We've seen very bearish sentiment over the last few days. Now, from an intraday trading perspective, you've got to have that in your mind, and you've also got to have in mind the fact that we have the Fed meeting tomorrow, which is going to be key, not least for equities, as indeed other markets. And really, just to put this into perspective for you. This is the open of, this is Globex. This is where we've now opened on the US physical market running in parallel with the electronic market. So we have the two markets running in tandem. That causes a surge in volume, which we see here. And for us, it's 2:30 UK time. That is when the US markets get underway and the physical market joins the electronic, which trades pretty much 24/7. We had the rally. The volume profile that we will normally expect to see with the open is very much this, where you get the surge of volume, lots of volatility coming in over the first 5, 10, 15, 20 minutes. This is very classic at the open of the indices. The volume then starts to naturally drain away, and you then settle into the volume for the session. because we can't compare volume here with what's gone on here because this is the electronic session. What we're comparing here is the volume in this period here where we've been trading for a little over an hour now. And what are we seeing right now? We're in congestion. The market has tried to rally. We saw the initial rally, perfectly valid to take some points. After all, we're going from somewhere down here at 830 through to 930, so 100 points on the index, which at $5 a point is 500 US. So it's perfectly valid to take a trade. And one of the great indicators for doing that is the Renko chart, because it does smooth out a lot of this volatility and really does smooth the pattern of price action into a discernible and very solid trend. That said, it's also, we are trading against the dominant trend right now, and the dominant trend right now is one where these markets are surrounded with fear and uncertainty. You've only got to look at the VIX. The VIX was up at nearly 25 yesterday. It's not coming off those highs, whereas before it used to subside, the VIX would decline and equities would recover. What we're seeing now is an awful lot of uncertainty, huge uncertainty, not least surrounding, obviously, the whole issue of trade wars. We've got Brexit, which is perhaps of a less of an impact for, as far as US market is concerned, and obviously the meeting tomorrow. So it's no surprise to see a very hesitant attempt to rally. And it's really reinforced by the fact that we're trading around the volume point of control here, which is this dashed yellow line. And what that tells us is that this is the fulcrum of the market right now. The market is in a phase where, if you like, we're in price agreement. There is no strong bias one way or the other. There's no strong bias to the downside. There's no strong bias to the upside at the moment. We are just trading around this fulcrum. You can think of it like a seesaw. It is the fulcrum point of the seesaw, and the two sides of the market, the bearish, the bullish sentiment, if you like, are equally weighted on a 5-minute time frame right now. And that's just reinforced by the fact that we're seeing this build up in volume, because what's happening as time passes, we're getting more and more volume building in this region, and it just reinforces the point that the volume point of control is here. Once we start to move away from that, once price agrees to differ and we get sentiment in one direction or another, that is when you start to see the breakaway, and that then is confirmed with volume. But right now, what we're seeing certainly on the 5-minute, we go up to this is the 10-minute, exactly the same situation here. Just pull that over. We've got pivots up here, so the market's tried to rally, it's fallen back, we're trading around the volume point of control again. So, this is just reinforcing on a 10-minute what we're seeing on the 5-minute, and it's just another reason for looking at markets in different time frames, because what it will reveal is reasons that the market has paused. And indeed, if we hop down onto the 30, this is the 15, and again, you can see the volume point of control there, but if we hop down onto the 30, there's yet another reason that we've paused at this level, which is simply that the volatility has been triggered on this particular candle. At the open, we had the volatility triggered, and the nice thing with the volatility indicator is it triggers in real time. So once the condition of average true range has been met, in other words, the price action has moved outside the average true range on that particular time horizon, then the expectation is that the market at the very least is likely to congest and may even reverse, but at the very least it's going to congest. But what happens is that these two little arrows are triggered instantly the minute that the average true range for this particular time frame and for this particular instrument have been met. So as soon as you see these conditions triggering, it instantly gives you a warning signal that perhaps we're going to see congestion, perhaps we're going to see reversal, but it's unlikely that the market is just going to continue on higher once you've seen that trigger of the volatility indicator. Not always the case. On occasion, you'll see the volatility triggered and the market will continue on higher and not move into a congestion phase. But nevertheless, it is a warning signal. And what we're seeing right now is we're seeing that bearish sentiment start to take hold once again up on the 5-minute. I haven't got the volume on here because I've got a lot of data coming in, but that will close off. The volume candle will close off once that has completed on the build. Let's just move down onto the Renko. This is the Renko. And the Renko, as I say, it just smooths out the price action. It helps when you're using it in combination with a time-based chart. It works in exactly the same way. I haven't got the trend monitor on here, but the trend monitor will work in exactly the same way. These levels here are all potential support and resistance levels. And the wider the line, then the more developed is that area of potential support or resistance. And the thinner the line, then the less strong that area is like to be. So once we get down to this one, for example, if that is going to be breached, then that is a fairly strong level. We've taken out this level. We're now looking possibly to take out this level. And you can see the way the trend dots work. It's the trend dots on the Renko indicator and the various levels. And I haven't got the trend monitor on that at the moment. But it just smooths out the price action. And it really does help in not only getting you in, but also helping to keep you in once you're in a position. Now what we're seeing, again, if we pop up onto the 5-minute, it's what I said earlier on. The volatility indicator has been triggered again. You can see it here. This candle hasn't closed off just of yet. But what's happened is that has now, but that price action clearly has moved outside the average true range. Now what we're expecting to see, we've got some support below here. Now we expect possibly the market to move back inside the spread of this candle. It'll be interesting to see if it does. Given that the bearish sentiment we've got in place at the moment, it wouldn't be a surprise to see this carry on much lower. But as we get down to these levels here, look at the amount of potential support we've got here. This is very solid price-based support. You can see it over here. Over on the left hand of the chart, we've got all this price action here. So there's a very strong level of price potential support there, which could cause the market to at least pause at that level. The corollary to that is on the volume point of control histogram, which is the histogram here. You can see we've got very light volume. So from a price perspective, this is a very strong level and could act as a platform of support. The volume node here is very narrow, it's very light. So from a volume perspective, in terms of volume acting as in the same way as price-based support and resistance, it's viewed through the prism of volume. It's a low volume node. So the expectations, we've got two conflicting views here. We have price support, which is telling us that this could act as a platform, but the volume here is very light. So it's a question of seeing what actually happens once it approaches this region and also the associated volume. But the point I make is this: the volatility was triggered here, so we're expecting possibly further congestion to develop. Let's head up to the 10-minute, exactly the same there. Volatility indicator has been triggered. We've got a very solid region of potential price support developing here. And on this time frame, we've got much more developed volume in the regions immediately below. And you can see just by eyeballing it, you've got this price support here. So to break through that region is going to take effort. It's going to take volume. Would I be doing anything at the moment? No, not at the moment. But again, it's a question of risk. Bear in mind, this is running on 14 points. This is a 14-point Renko. And the way that's calculated is it is the Renko optimizer on Ninja, and it does it all automatically. I've just selected the 1-minute time frame here, and that's currently delivering 14. And what that means is that each of these bricks is worth 14 points, which at $5 a point is a healthy return. So taking anything out of this this move, it will give you a decent return. It doesn't look a lot here, but rest assured it is, because of the nature of these bricks, which are quite wide for the YM. If this was on the ES, these might be 2 or 3 points, and different again on the NASDAQ. Let's pop that down, see where we're going. Let's just head over to the tick charts, which is an equivalent workspace. And if you've never traded on a tick chart or indeed a Renko, the principle that governs both those is simply this, that they are time-independent charting techniques. Because on a tick chart, for example, I'll set these up in a minute, but on this one, we've got 568 ticks on this one. So in essence, every time 568 ticks go through the market, then the candle is formed. Now that's completely independent of time. That is only governed by how long it takes for these 568 ticks to go through. Once that's gone through, the candle closes, we're on to the next one. So it's independent of time. So what you see with tick charts, and also what you see with Renko charts, because they are time independent also, is that you see momentum. So as the market speeds up and slows down, that momentum is then revealed directly on the chart itself, which you don't see on a time-based chart. So it's just a great way for intraday trading, either using tick charts or Renko charts, or indeed either of them in combination, but particularly Renko in combination with time-based charts. These are just great ways to reveal momentum, and also, certainly in the case of the Renko anyway, to smooth out the price action. What's also interesting over here, this is the tick speedometer, which basically calculates the optimal tick setting for your charts, because it's guesswork otherwise. In the same way it is with Renko. That's why we developed the Renko optimizer, to actually calculate the optimal setting for you for all markets, whatever it may be you're trading. The same is true with the tick charts. With the tick charts, unless you're going to guess what the tick setting is, you never really know for any market what it may be. And these, of course, change. As you can see here, these numbers here are constantly changing throughout the trading session because markets speed up and they slow down. So the optimizer delivers the tick settings that we then set the tick charts up to over here. We've got 3 of them. What it also does is it highlights with this color system when the ticks are actually falling away. In other words, whether activity in the market is low. And when it goes to slow, this red, that is telling you that there's very little activity in the market. The tick activity has fallen away. The market is likely to go into sideways price action because the participation has fallen. When it changes color back to orange or up to green, green is high activity. Orange is the average, if you will, the expected norm, if you will, of an intraday trading session. But as the flip-flop between red and orange, then certainly when it's on red, then that is telling you the market has slowed right down, the activity is waning, participation is waning, and therefore we're not likely to see fast action on the price charts. And that's what you want to see, because as an intraday index trader, you want to see at the very least these markets running in orange and green. And when green comes in, then you know for a fact we've got high volume coming in, lots of activity coming in. And what this also does, it also blends volume price analysis. Let me just pull that open a little bit, see it a little bit better. Volume price analysis with a combination of using tick-based charts. So you're getting the best of all worlds. And there's just a nice example here. You can see the volume coming in here. We've got high volume, which is pretty much the highest on the session. Not quite. That was the highest session there. But you see this volume coming in. And you see this candle formation here with this deep wick to the upper body, narrow body, lots of volume. What is that telling you? It's telling you that that's weak. That is a sign of weakness, because you've got volume being driven into this market, but the market is not responsive. So there's heavy selling going on in this candle, purely through the prism of the candle itself. You would infer that anyway, purely based on the wick to the upper body. But moreover, once you attach volume to it, it's telling you loud and clear there's heavy selling coming in. And what are we going to expect? We expect to see this market, at the very least, weaken, possibly roll over. Then it's a question of a judgment call as to how far that market is going to fall. And you look at, obviously, the reverse of that. You're then looking at potential opportunities for reversal trade when the buying comes back into the market. But that's why we developed the tick speedometer. It covers many different things, not least to deliver the tick count for these tick charts to be set up correctly and at the optimal setting, but also to give you a heads up on when markets are sluggish, when they're active, and also to blend volume price analysis here with running the benefit of a tick chart over here on these 3 here. And changing them is very, very simple. You literally just, on NinjaTrader at any rate, just type in. The reason there are 2 numbers here, by the way, is because this is the actual, which changes very fast and very frequently. This is the closest fib number to the actual, nothing to do with Fibonacci, other than it was a mechanism to allow us to give a number that was required changing less frequently. So from a personal perspective, when I'm trading on the electronic market, which is less volatile, I'll use the actual. When I'm trading on these markets where both are running in tandem, I'll tend to use the fib number. So you literally just type that in over the top there with a T on the end, and that changes over to the 610 tick. And just change this one over, just move that down a little bit because it's hidden below there. Where are we? That's at 987. Let's move that up a bit. There we go. Oops. 987. Just change that one over. There we go. And now we're running on the correct speeds. And as you can see here, we had the trend monitor transitioned, went into bright red. It's now perhaps transitioning again. We've gone to a darker red, so it's possible this is now going to reverse higher again. But you'll only see that reflected on the trend monitor on the slower time frames. And when I talk about slower time frames in the context of tick, I'm obviously talking about the different tick speeds. You'll see that reflected here. And what will happen, it will ripple through from the fastest tick chart to the slowest tick chart, and exactly the same way as on the time-based charts. Let's just go back to the time-based charts and see what's happening there. Let's pull that one up. Let's get that out of the way. There we go. So we had this was on 5 minute. We had the volatility triggered. What happened? We've actually reversed back inside the spread of the candle. And these moves, it's such a powerful indicator because, as Anna mentioned, the fear of missing out is one of the strongest emotions you will ever feel. It is actually stronger than the fear of a loss, believe it or not, because what happens in the fear of missing out is that the market moves rapidly. This price action fell very rapidly. It's so easy to think, oh, I'm going to miss out. There's some points here. I'm just going to jump in, grab some points, easy money, off to the races. And then this happens and it reverses back inside. And now the emotion is fear. Have I done the right thing? Why did I do that? Why was I drawn into that when I knew something like this was going to happen? And it's just an awful feeling that you've rushed in, you jumped in too early, and now you're paying the price. And paying the price, and this is triggered by the market makers and big operators because they understand the two levers of emotion. And what's happening now is that all these traders who jumped in short are now being squeezed with the emotional pressure of time, which is passing and not delivering what they expected, which was a move to the downside. Now, ultimately, that move may come, but it will come with some pain if they're prepared to wait that long. It might have been stopped out, of course, on the reversal back here. But that is how it works, and it's just such a powerful indicator. We head over to the 10-minute, exactly the same there. We've got a deeper wick to the lower body there, but the same principles apply. We've got volatility, and we've got indecision, and we've got sideways price action. We've got it on 15, exactly the same. We've got volatility again. Let's pull that out. There we go. And we're trading around inside it. Yes, there is money to be made. We are trading in 100 points. So if you're light on your feet and you're quite happy to accept that sort of risk of trading in these whippy price sessions, that's fine. It depends on your attitude to risk. It depends on your experience. It depends on your trading understanding of the price action and what is going on. Down onto 30, same thing here. We've got to volatility. We're trading inside now. We've got more volatility to the downside, so we're going to be trading around this region for some time. The volume point of control here, absolute ton of volume here. We've got levels up and down the chart. We've got some really strong resistance here, even stronger up there, up at 24.2. We've got a very solid platform here, which wasn't actually tested on that last move lower, but it's holding for the time being. Another one down here, which formed a base for this minor rally here. So there's lots of price support and resistance around. That's on the, and then over onto the 60-minute. Have we got any volatility on the 60-minute? No, we haven't. But we're still trading around the volume point of control. So every chart is telling you the same thing right now. This is a market in congestion. It's a market that's trading in a relatively narrow range. If you're going to take any trades in here, you've got to be quick. you're not going to be hanging around in here for certainly no longer than a few minutes probably. You've just got to be in and out, take what's on offer and get out. If you see an opportunity, fine. Do not expect to be sat here for the next half an hour, because you won't be, because this is just whipsaw right now. Let me just switch off, pass back to Anna, see if there are any questions. For the time being, it's just going sideways. If you were looking at this as a potential setup, which I guess is the next question, if you're considering doing something other than just, let's say, I don't know, let's go up to 15-minute maybe. Where are the levels you would look to get in? It's a tough call right now, because whichever way you look at it, there are reasons not to get into this market. Let's have a look at 5. I mean, to the downside, for example, if you were looking at this just as a straight trade to the short side, the first thing you've got to decide is, given that we've got this level here, which is very strong, plus you've got a ton of volume in here, how comfortable are you taking an opportunity where you're going from something like 810 down to 770, which is 40 points, given the amount of volume and given the prospect that the market is probably not going to get through that with any speed or alacrity. So it's very, very, very choppy right now. And as these congestion phases build, then you've got to look at the levels. Let's go down to 30, take a slower time frame. Again, if you were looking at this as potential trading opportunity, you've got a level here of potential support. You've got another one here of potential support. So if you got through that, okay, you've got 50 points maybe before you hit some further congestion down here, but you've got to get through here first. And by the time it's got through there, it may even be halfway down through this secondary region. So it's really not very conducive to taking a trade on that particular time horizon. To the upside, if you were looking at it as an upside opportunity, you've really got to get through here, 950, and then you've got a quite a serious area of price action over here, and you've also got quite a strong level of volume over here too. If it got through there, then this area up here is a little bit lighter in terms of volume, so you'd be looking at maybe 100 points in this region. Whether it's likely to get to that today seems unlikely. It's kind of got much more bearish sentiment to it than bullish for the time being. But those are the sorts of things you look at. And you'd also look at Renko. If you're on an intraday perspective, you'd be looking at these levels. You can reduce these levels, take the smaller ones off the chart, so you're just left with the deeper areas of support and resistance. But again, just looking at that chart, same sort of picture would apply. It all looks very congested. There's not a lot of clear water either to the upside or the downside for the time being. And it really just does reinforce how powerful this indicator is and what it's telling you. It's telling you volatility. It's telling you the insiders and big operators are in there. We're trading around the volume point control. Everything is signaling the same thing. We're not going anywhere right now. We have no direction. So it's a question of being patient, which, let's face it, none of us are good at, but we have to be. And that's what happens here. You see these rapid moves, and they'll often come after a period of congestion. You think, fantastic, I'm going to jump in because I'm bored, or I need to be trading. I'm a full-time trader. I've got to be trading. If I don't do anything, it's, how can I have a job when I'm not seen to be doing something? Well, that's, again, it's one of the emotional drivers, to be seen to be doing something. Boredom is a great factor. It really is. And being patient is one of the hardest things to do in trading, and just wait for something to develop. Nothing may develop. There are days on indices in all markets where you look at the end of the day and it's been a slither of price action, maybe with a very narrow price action, maybe a little doji with a little wick to the upside, downside, absolutely gone nowhere. You know, it's no great surprise after big moves. We've had some really, really big moves. It's no surprise to see this sort of price action follow. And particularly bearing in mind what's coming up, you know, tomorrow, coming to the end of the year as well. So there's all sorts of factors at play right now.
Can I just say something?
Yeah, just going to pass back to Anna for a change of voice.
You may have noticed I've actually put a link in on the in the chat box, and it's from the a blog that I recommended a couple of weeks ago. It's an academic who just writes about the Fed. You can sign up to his email, and it really is worthwhile because it really lays out what may or may not happen tomorrow, and it's very easy to understand and very easy to read, which is also very important. And I can't stress enough the importance of tomorrow's Fed interest rate decision. Not so much the interest rate decision itself. It's almost the market is expecting a rise. It's what's going to be said and the extent to which what we've seen in equities is going to impact what Powell may or may not say, and also there's a very strong political element to this. You don't have to follow Donald Trump's tweets to know that he's made his feelings very clear about the Federal Reserve, and we'll be looking at the forex side of things on Thursday, where we've got a webinar on Thursday. So it'll be interesting to see what the dollar index is doing, and I've got the dollar index up here. It's one of the charts on my indices profile on MT5, and again, it really is in a range. As I mentioned last week in the forex session, that we've got like a triple top up there, and this is the other thing you have to also consider. In fact, David very kind also made a comment in the chat box earlier on, and that is to say, you have volume price analysis, you see these individual signals, you have maybe have the quantum indicators as well, but you must also you combine them with what the charts are saying to you in terms of patterns, in terms of support and resistance, so you get a complete picture of what is likely to happen next. And certainly the dollar index is as I said, it is also been in this really in a congestion phase. As I said, it's got it's tried 3 times to move above. It starts with 97.50 to the upside, and the downside, it's actually just peaked below the S4. It's actually bounced off my own 200 moving average. I actually use one that's it's called the fractal adaptive moving average. I've been reading some very interesting academic research on this particular version of the 200 MA, and in fact the same piece of research also looked at the use of time, trying to time the market, and VPA is very much a timing methodology, but as I said, if you're looking at the monthly chart, you have to allow the signal time, forgive the pun, to develop. And I think the conclusion of this particular piece of research was that in fact applying some kind of timing methodology to trading and investing decisions did actually come out way ahead of just simply buying on other metrics, be it for stock spaces, just fundamentals. It can be done, and certainly with VPA, it's I think it's David and I agree that it is the only methodology that will give you at least a heads up, as it were. And just to go back to the volatility indicator that I know we go on about it a lot, and it is an indicator. All indicators lag in some way. That's by definition, what they do. The exception is the volatility one. It triggers in real time, and I couldn't believe, I actually looked at the price of it, and it's $57, and for $57, it immediately tells you if the the move that you're in or a move that you're thinking of getting in is either going to come to a pause, if nothing else, and you can make a decision once the indicator is triggered. That's what I was going to say. Can I come back to you now? Is that okay?
Yeah.
Yes, I checked it out. I couldn't believe it was.
Welcome back. I'll just close my chat box off for a moment and just see how this develops. Let's let's pop back to the 5 minute and go back over to the tick charts in a moment. And it really does illustrate it all. Let's just pull that, and you can see how much volume is building. There's a huge amount of volume building here at the moment. Plus, you've got these potential platforms below. Sorry, Dang. So for a strong move to develop, just move the chat box out of the way. For a strong move to develop, it really is your personal view of risk and what it is you're trying to do and how comfortable you are jumping in and out of the market, taking maybe a handful of pips on days like this, or pips or points rather. On days like this, it is very much a case of the latter. That's the nature of what we're dealing with right now. But a lot of traders would shy away from trading in this. I would class myself amongst them. It's not, I'm not. This is not the sort of price chart I would be looking at. I've got to wait. I've got to be patient, and I've got to wait for something to break, something to develop. If I was looking at this as an opportunity, the sort of levels I'd be looking for it certainly to get through all of this here, through these regions of price support, potential support. Once it's through here and through here, then you've obviously only got this one to deal with, and you've also got low volume here in terms of the volume point of control. So at that point, that is the sort of rationale I would apply and look for a potential move. Should the bearish sentiment take hold, we see a strong move away from the volume point of control. If that's associated with strong and rising volume on widening spread candles without huge wicks to top and bottom, trend starts to develop, that's what you're looking for. The trend monitor's already transitioned through on 5 minute. We've seen the bullish sentiment has now changed. We've gone into the darker blue. There was no transition through to the darker red. We've gone straight through into brighter red in terms of the 5 minutes. So the bearish sentiment is starting to prevail once more, but that has not transitioned yet into a tradable trend as such. You can also see, and this is how it works, because it is just the pebble in the pond analogy, which is the ripples as that pebble falls in the pond, the ripples move out. And that's what happens exactly the same way in time frames. On your 5 minute, you're starting to see that shift in sentiment. You're starting to see it now on the 10 minute. Probably nothing on the 15 minute. That's still reflecting the bearish sentiment of this rally, which was hardly strong, but nevertheless it was there. And we've seen no shift in sentiment in terms of trend monitor there. So the trend monitor is still bullish because it takes a longer perspective view of the trend. And it's just great at holding you in once you get into a trend. What the trend monitor does, in a similar way to Renko in some respects, is it smooths out the trend for you. So instead of seeing those changes as you see those pullbacks and reversals, which are so deadly, what it will do, it will tend to smooth through those, and it will only shift in color once you start to see a true change in trend developing. That's how we developed it, because it is, again, it's one of the hardest things to do in trading. Once you've got a good position in the market, you've got to try and maximize it, and it's so easy to be thrown out of that position by reversal, because they happen in all time frames, all markets. The market's trending nicely, then it pauses, maybe pulls back against you, you're frightened, you close out, then the market continues in the original direction, and you're left with trader regret. We've all done it. It's one of the hardest things to do, is maintain a position that's profitable and continue holding it for greater profit. It's so difficult, and that's what the trend monitor was developed to do. So it takes a more considered view of the trend as it develops over time. No change on the 30-minute, you wouldn't expect it, and certainly nothing on the 60-minute either. And just going back to, where do you get in? What are you looking at? It's going down to the slower time frames also gives you perspective on where potentially you might look to get in even as an intraday scalping trader. And again, you've got this region here. Now, if we get through that region, then below that we've got low volume area here, which is very positive for us. So that's, it's a nice thing to see. We've got a very strong 2-bar reversal here. If you overlay those two candles, and you looked at this, we're on the 60-minute. So if you punched in 120-minute as your time frame, what you would see here is a 2-bar reversal. In other words, an upthrust candle. It'd have a big wick to the top and a very narrow body. So overlaying those two candles is very easy to do. And the volume here is as you would expect because we're in the physical, and that is not indicative of any change through here. This is just Globex. This is Globex plus the physical. So the volume, we can only compare these two volumes here to get a perspective on where we are, other than we've got a lot of selling in this candle. In fact, higher selling in this candle, greater than the buying that was on this candle. But nevertheless, that gives you a perspective on potential levels where you might look at opportunities going right the way back up to the 5-minute, which would help to ease through all this region around here and get you into a stronger position based on a very slow time frame chart, which helps to complete the picture, if you will. It paints the whole picture of using multiple time frames.
Okay.
Yeah. And just heading up to the 10-minute. Whenever you see candles like this with these deep wicks, that's just telling you it's weak. Markets try to rally, fallen back. Markets try to rally, fallen back. Looks as though you might have a repeat, try to rally. We've got the wick up here up to the VPOC, falling back. The volume here is fine. It's not as high as here. It's settled. It's what I said earlier on. You tend to get this attenuation in volume once the market gets underway. It falls away from the peak of the initial entry, or the initial open rather, and then we gradually flatten down and get more even pace price volume as the markets start to settle and get into where they are truly heading. Yep. If this one gets through there, if that price action closes below there, that's positive. We've got to get through this price action here. And then we're on down to the next levels and possibly an opportunity developing to the short side. We will see. I'm going to pass back to Anna at that point.
While David was on Ninja, what I had up here was I was looking at the 5-minute equivalent over on MT5, and exactly the same combination, configuration of candles, exactly the same. What he was saying applies equally as well to what we see on MT5. And what was interesting, we were talking about a low volume node. He was speaking here, this was a weak candle, a weak candle, a weak candle. Wicks to the tops of candle is always suggestive of weakness. We've also got the volume point of control here. It's also adding its own bearish pressure. And as soon as the price action got to this low volume node on the VPOC histogram, it actually went through much faster than it, when it was trying to sort of trudge its way through an area where you have a deeper concentration of volume. Now, where is that going? Well, we have a support line down here in 23,730, and just to compare what is happening on a slower time frame using time-based charts, I've got the 20-minute here. You can see here, in fact, the start of this move has actually been the break from the VPOC. We have the down candle. Again, you have to look at volume relative to the session that we're in. This is obviously what was going on in Globex, and we had the open of the market, volatility coming in, the volatility indicator was triggered. A lot of volume, as you would expect. Price retreated to within the spread of the candle, and I can assure you, there'd be lots and lots of traders seeing a dramatic price action going higher. Great, it is going to go higher. But because we understand what happens when we have this indicator triggered, the expectation is the price will retreat to within the spread of the candle, and it jolly well did, as we can see here. Now this is actually the 20-minute chart, and we had a doji. A doji isn't always a sign of a reversal. It's sort of indecision, but there was a lot of volume underneath it. Then we had the first sign of a major move lower, which was this candle here, good volume underneath it, and now we're seeing this candle here. As I said, this is on the 20-minute chart. It's got a wick to the top of the candle, but it's going through on this time frame quite a dense area. And you can see the congestion here over to the left of the chart. The bad news is if it gets down to this area, which is 23,647, again, we've got this low volume node here. If it does get there, then you can expect it to go fairly fast. It's the speed with which it is likely to go through that region. But we will wait and see what happens. Is that okay, David? Any questions? Lovely. Anything you want to add to that? I thought the MT5 really sort of explained it really well. And you can go up to, as I said, you can see it on the 30-minute. The 30-minute we can see here, we've actually got the volatility triggered. Now you can say, well, it's outside that range, but you have to look at where it went. 30 minutes ago, it actually went inside of the spread of the candle before looking to, it seems as though it's going to go lower. And again, it's got to get through this dense area. We can see the low volume node down here. We go right up to the hour. What is the hour telling us? We've got a nice 2-bar reversal on the hour. So we'll see whether that plays out. But again, it's for this to go quickly, it has got to go through this, as I said, these dense areas of price, of volume. The VPOC is based on price, volume, and time, and we're using time here to help us try and establish how long the price action is likely to stay in the region that it is at the moment. So, any questions? Is that it? Anything you want to add to that at all? No, that's fine. I'll go back to my 5-minute chart, see what's happened. We had a little bit of buying coming in here, but it's still going lower. But we've seen in the slower time frames, what it is that we are likely to encounter ahead, as it were. But it's still looking. It's looking bearish again. Do you think so? Is that what has the Renko? I haven't set the Renko up on my MT5. I can do. I have a Renko version. I don't have a tick version that David has, because we can't do that with MT5. But there is a Renko chart version, which is absolutely great because it really helps to refine your entries, keeps you in, and also helps with your exits. So let's just been going for over an hour. Just very quickly, the NinjaTrader indicators and also the MT4, MT5, you can find details at quantumtrading.com. You can see here each individual indicator is detailed, the cost of the indicator, there are videos, there's support pages, and as I said, when I looked down, I hadn't looked at the price of the VPOC. If you don't have if you don't have any of our indicators and you're thinking of investing in them, then the one indicator I would probably suggest that you invest in is if I can find it in a minute, is the volatility. As I said, it's only $57. Anything you want to add to that, David? No, if you do go for the complete package, that is $749, but you can have one, you can have all sorts of combinations. It's all on the website, and if there's a combination there that you're interested in and it's not featured, you just have to drop us an email and we will do you a special price. You can pay outright or you can pay in 3 monthly payments, and we also offer a 7-day money back guarantee. What we also offer is that every time we develop a new indicator, as we have done with the optimizer and with a Camarilla, and there'll be some others in the future, is if you buy the package, then they are automatically added to your package. Whatever you pay for the package, that is it. If we when we develop, when we upgrade, the upgrade is for free. New indicators are added for free as well. And as I said, if there's more information that you need, you can either drop an email at helpdesk@quantumtrading.com, or you can email david@quantumtrading.com, or you can email me, anna@annacooling.com. And just finally, before I forget, because I always forget, go back to my new front page. There we are. These are all the books, individual books. And what we've also done now, we've actually bundled them so that it becomes even more cost effective. So you can buy, as I said, just to give you an example, the Forex library. I know we're not talking about Forex today. The Forex library, the complete Forex library, there are 4 books. They're only $9.99. But the one for certainly this session would be either the volume price analysis across all the markets, or the 2-box set for the 2 books that I mentioned earlier on. Anything do you want to add to that? Lovely. All that remains for me to say is thank you so much for coming along today. We're actually back the last webinar of the year, which is on Thursday, which is going to be Forex. And I mentioned earlier, we're going to be doing this more often just for indices, and we're going to do maybe 1 or 2 commodities. The stock one we're going to do separately, and of course we'll carry on with Forex back in 2019. I can't believe another trading year has come and gone. Whatever you're doing over the next week or so, celebrating Christmas, whatever holiday you are going to be celebrating, have the most wonderful time with your family and friends. All I can tell you is if 2018 has been lively, I think 2019 is probably going to surpass it. David, what's your opinion? Yes, David is giving me the thumbs up. And certainly here in the UK, it's going to be a lot of fun and games. I even read a headline today that said the army is on standby for March the 29th. I think we're actually going to be in Italy that time, aren't we? Let's hope they let us back in. We'll see. If you're trading the rest of the week, have a great trading week. And as I said, have a great holiday, and we will catch you next time. Take care. Bye-bye.